Look, CropLogic is an agronomy services company, and we're sitting here right now today with some 60,000 acres of high-value crops up there in Washington State under management right now, and revenues of around 2.3 million Australian dollars. Really the difference for CropLogic as opposed to others that you may see out there in the ag space is that we're really blending hard science with agronomy and using technology, I guess, as the glue to knit those two together. If you have a look over there on page 3, there's a picture of an agronomist out there in a field, and I guess this is really indicative of what the current methodology of delivering agronomy services to these large-scale crop growers is. There's still quite a high dependence on these agronomists actually having eyes on the field, and that's so that they can get out there and they can ascertain whether there's a weed problem or a pest problem or irrigation or whatever else. And obviously their ultimate goal is really to help that grower increase the yields out of their fields. So this is very much a hands-on approach. But if we go back to where CropLogic has come from originally, it was spun out of the New Zealand Institute of Plant and Food Research back in 2010, and based upon 30 years of research into essentially how plants grow and the way that we can alter various inputs to affect a positive yield output at the other end. And really what that research was systemized. So we've got the hard scientific approach to improving yields in crops, and we've got obviously this traditional way of delivering the service in field, as you see on page 3. And it's really the technology, the way that we're integrating those two approaches to really deliver the maximum benefit for farmers. If you have a look on page 4, I think you get a bit of a view of why the agronomy service industry has really been quite difficult to scale. I know that those are only little pictures or little dots on a map there, but it's actually that is a satellite image up there in Washington State. Each of those fields that you're seeing there is 100 acres, on average, 100 acres size. So if you think back to that agronomist that is trying to identify problems and trying to manage those fields for farmers there, it's an incredibly logistics-intensive industry to be in. Getting from field to field to field on a once or even twice weekly basis means that these agronomists are essentially becoming taxi drivers of their measurement equipment and just, getting those eyes on field. So what we've seen up there is that it's very difficult to scale those businesses. It's very hard to decouple the requirement for more human resource from the desire to service more acres. I think that's also reflected with the number of agronomy service companies and individuals that you see out there in the US. There's something like 8,000, or there's actually over 8,000 registered with the Agronomy Association up there. So that really just reiterates the amount of fragmentation that we see in the market. And look, that fragmentation also plays into our go-to-market approach. I think you may have already read through some of the material, but our go-to-market in these new areas of interest for us is based on acquisition. The reason why we're focusing on acquisition as being a good go-to-market strategy is that it really essentially de-risks that market entry for us. Anybody that's been in the ag space will know very well that it's quite hard to sell technology past the farm gate. These growers have generally got trusted relationships with these agronomists or with parties that they have done business with over the past years, and it's quite hard to break those down. So our approach really is to pick up those relationships and to use our technology to start transforming the underlying cost structures for delivering those services out there into the fields. And look, the way that we're doing it, there's quite a high-level diagram there on page 5. And you can see there that essentially we're using that combination of technology science to really provide that full agronomy service suite. You can see down the bottom there that we're using in-field probes to pull data out of the fields. We're also correlating that back to meteorological data. We're doing soil samples, doing soil tests at the start of every crop cycle. That's not just the soil composition, but also a chemical soil analysis so that we know exactly what those plants are growing in. And then we're correlating it back to the plant models, and that's really the subject of a lot of that 30 years of research. And then finally, we're bringing all that data back into the cloud, where we're running it through a patented method. Now that method is highlighted a little bit more there on slide 6, where you can see, the extent of the complexity of that algorithm. We bring all that data in. So, for example, the fertilizer, fertigation decisions. We're using the weather data. We're using the soil data. We're bringing that back into both a crop model and a soil model, so that we can start predicting out what the yield impact is going to be of the decisions which are being made at the current time. And look, there's another benefit to this as well, and that is that if farmers are operating under resource constraints, say for example they've got nitrogen or water allocations, then we can start applying this back to the crop model, to the actual requirements of the plant, to say that the best application of those resources is at certain periods during that growth cycle. So really we're moving away from this normalised approach to managing crops and tailoring these decisions back to the requirements of the plant, and not just going out there with the intention of keeping fields wet. Over there on page 7, you can see the extent of the work that we have done since the company was spun out back in 2010. I mean, obviously that 30 years of research was the original IP position which we've built the company upon. But subsequent to that, we've done, well, at least 5, but actually 6 years of field trials in some of these large nations around the world. You can see from the numbers there that we've spent the vast majority of our time up there in the US market, and there's a really good reason for that. The US, we're targeting farms of 1,000 acres plus. They all need to be irrigated farms as well. And for us, that's the biggest sort of consolidation, I guess, of those particular farms in one country for us. We know very well that the infrastructure is generally in place up there, and we know also that 80% of those farms that we're targeting up there in the US market already employ the services of an independent agronomist. But anyway, you can see that we've done over 550 field trials up there in the US. We've also been in China and done some field trials there with PepsiCo. We've been in New Zealand with McCain and Australia with Simplot. But like I say, we've just got to go back to the amount of trials that we've done up there in the US market. And that's been done with a company called Lamb Weston, which is part of the ConAgra food group there. Lamb Weston's the biggest potato processor up there in the Pacific Northwest. And for us, potatoes has been the first cab off the rank, essentially, in terms of our crop decisions. There's a reason for that too, and that is that potatoes are a very high margin product. So it means that it sustains the revenue model that we're after. And also it's quite a highly vertically integrated market as well. So we see that growers are generally quite close to processors up there in that market, which just suits us down to the ground really. Over on page 8, we're putting a bit of a face to the name, I guess, of our technology. These are the probes that we're building at the moment, and these probes are being deployed out into these fields. The average field size, as I've mentioned, is about 100 acres. We're deploying 2 of these probes per 100 acres, and that allows us enough of a sample to be able to extrapolate across the field, and is generally what's been the same sort of role that has been employed, with traditional technology up there in the US market as well. So we know that it's suitable. The probes really, the first and perhaps largest factor that they're monitoring is soil moisture. We know from our 30 years of research that a healthy plant should be drawing a certain amount of moisture from the soil at any time during its life cycle. And if it's not, it's generally an early indicator of plant stress. So it's important that we can monitor what's going on under the ground, particularly with these underground crops, of course, and so that we can identify these problems early and we can react to them early and save yield as much as possible. On top of these soil moisture probes, we're also doing temperature within the field. There's a little rain gauge at the top, and that's not necessarily for measuring what's coming out of the sky, because you can get that elsewhere, but it's for tracking what's coming off the irrigators as well. And that means that if a farmer comes back to us and says that they've applied 2.5 inches of water over the past 2 weeks, then we can actually validate that. I think you can get an appreciation that the algorithms that we're using behind the scenes are quite complex, which means that we really are quite dependent on decent data going in to get a decent result out. On page 9, we'll just talk a little bit about aerial imagery. We use aerial imagery again as a basis for removing the requirement for those agronomists to actually be out in the field physically. When we're talking about 100-acre fields and we've got agronomists out there looking for, signs of pest or weed outbreak or whatever, they're still quite limited by the amount of ground that they can cover by foot. So when we're using these ultra-high resolution aerial imagery shots, we can actually extrapolate problems. We can work out if there's issues with irrigation or emergence or pest or weed, and we can do it a whole lot more reliably than just the person that's walking around the field. And look, on page 10, really, this is why we're looking at acquisition as one of as our market entry strategy. I mean, we can fundamentally change the role of that agronomist. This data came out of a South Canterbury potato field a couple of years ago. And basically what we were doing here is using our modelling systems, using that sort of complex modelling behind the scenes to determine or to predict what the soil moisture was going to be in the field right the way through that season. So that was being done completely independently of any physical measurement. It was done being based upon what we knew about the soil type, the chemical structure of the soil, the variety, the age of the plant, the irrigation scheduling, absolutely everything. And then separately we were using physical measurements in the field, and that's been plotted out on the yellow line there as well. You can see there's quite a tight correlation between those graphs, but really when you're thinking about that agronomist and how we can make that business scale, it's those red points there that I've highlighted which are really the benefit for our business. Those red points represent times at which there was something happening out there in the field which wasn't falling within our models. So at that point there, we can send that agronomist back out there into the field and they can go and do what they were trained to do, which is essentially to troubleshoot complex problems in a very complex working environment. But I think you get the picture of that, that's right the way through the season. We've got about 7, 8, 9 visits there as opposed to the visits that they would be doing normally, which would be once or twice weekly. And if you relate that back to slide 11, where we talk just a little bit about the revenue model, you can see right off the bat that we've got the opportunity to really fundamentally improve the profitability of those businesses as we pick them up. $25 US per acre per crop is the charging model that we're using at the moment up there in the US for these high value crops. But as you can tell, in the current model, there's quite a high cost overhead there just in terms of having people tied up in cars driving from field to field to field, and of course all the expenses which are incurred as a result of that. But what we're able to do now is to be able to reliably take those agronomists out of the field. We're not eliminating the amount of time they're spending out in the field, but we are reducing it significantly. So we can start reducing the cost to service those acres to something more approaching that sort of 50% margin there. And then on top of that, apart from them being able to service more acres, we're then able to introduce some predictive services there which will increase the revenue again by an extra $10 per acre. And if I just explain that over on page 12, what we were able to do through our relationship with Van Western up there in the US market is get access to the full decision-making process that was employed by 5 of their top growers up there in the region. And with the benefit of that 30 years of research into how these plants grow and the best way of growing them, we were able to pinpoint the exact decisions that were being made along the way, which were impacting upon the ultimate yield. And I think it's probably easy to explain it like this. There's managing farms and managing crops like this, experience is built up over a number of years. And it's very easy to base the next year's decision-making process upon what's been used in the past. That bottom table there, you can see that there's a number of different varieties of plants which were growing across those 5 growers as well. And there's different gains that would have been realised, I guess, with a decision-making process based upon CropLogic as opposed to the current practice. If you remember, or if you think about why these varieties are even introduced in the first place, it's because they've got slightly different characteristics. Maybe one is more frost-hardy than another, maybe one matures a little bit earlier or a little bit later than another. But basically, because these subtle differences, there's a different requirement throughout the growth season as well. So they respond better to different practices or different management decisions which are being imposed on them throughout the seasons. And of course, if you're basing your decisions on how to manage these crops upon 20 years of experience, then of course it stands to reason that you're actually, potentially damaging the yield along the way. Look, 6.25% is the average gain that we were able to ascertain across those 5 varieties. 6.25% doesn't sound like a whole lot to anybody outside ag, but I think that top table there really shows you that, on a fixed, static cost base like this, with these are essentially commodity-grown companies with tight margins, that 6.25% falls straight to the bottom. And the bottom line impact on these farmers for using the system would have been some 90% increase in profitability across the board. Now, you've got to also remember that this was based upon the data and the decision-making processes that were being employed by 5 of Lamb Weston's top growers. So it only stands to reason also that some of those more marginal growers may benefit more from the system here. And I guess that this really explains why that $10 extra per acre per crop was reasonably well received up there in the market. Page 30 talks about where we are right now. I think I mentioned right at the outset that we've got a base of operations up there in Pasco in Washington State. We're managing 60,000 acres of high-value crops, and if we put that into context, the total state production up there in Washington is 170,000 acres. So we now actually represent some 30% of the entire potato production up there in Washington State. We've also licensed some new crop types, corn, cotton, soy and wheat. So really the intent of the Churchill war maps that you see there on page 13 is that we're going to be using those crop types and their suitability through the rotation of crops to push down through the Midwest and into the South. And if I just can skip straight to slide 15, just talking about the size of the target market and why the USA. The USA represents some 29 million acres of addressable market for us, and that has been segmented down to the 1,000-acre plus operations already. So it is potentially a market which is, it could be up to $1 million worth of revenue there, $1 billion worth of revenue. Outside of the US, we're looking at about 60 million acres, which meet that target farm criteria, which represents about $2 billion per annum. But you can quickly see that the US for us is a great target market for us at the outset. It also has great referenceability out into those other countries, which we're likely to be growing into as well. And I think that maybe if I just skip through the use of funds here as well. We're obviously raising between 5 and 8, and it's at an $8 million raise, we'll be using $3 million of that for market development and around about $3 million for research and development as well. Market development, half of that budget is going to be spent up there in the US market, just capitalising upon that investment that we've already made. And in terms of the research and development, we're going to be looking to develop the sensor platform some more. Build out the analytical platform so that it will scale, and essentially using that funding really to support the onward development of the company going forward. Now, look, in terms of where to from here for CropLogic, we went to the US and announced our acquisition to Lamb Weston, which is a large potato processor up there. The news was received exceptionally well, and Lamb has, the first question that Lamb asked us was when we can get down there or how they can support us getting down there into the Idaho markets, because they've got some issues down there they would like us to help sort out. On top of that, they then went and identified a potential acquisition opportunity for us down there in Idaho. Now look, in terms of the use of funds here that we've listed out for the prospectus, I haven't identified any of these acquisition opportunities. And the reason for that is that I can't point back to a signed agreement here. What I can do, though, is I can say that if we are looking at these acquisition opportunities, and there is actually another one in Australia as well, then we will be looking to use the funds that we're raising in the $8 million raise to essentially pay for those acquisitions. The use of funds that you see in front of you at the moment at the $8 million represents what we would need to get to cash flow positivity in approximately 22-month period. So that's cash flow positive for the entire group, but obviously with an acquisition strategy, that could be fundamentally changed just with one single transaction. And look, if I could just give you a couple of the criteria, or maybe one main criteria around acquisitions. We're not looking to acquire loss-making businesses here. We're looking for these acquisitions to provide us with that footprint into the markets with existing revenue streams and existing relationships. So we don't need to be taking loss leaders into these market entry strategies here. So I can't see that we're going to be negatively affecting the cash flow position as a result of acquisition. Look, in terms of the board of directors here, I can just quickly talk about them. John Beattie is our chairman. John Beattie was an ex-GM at Brierley Investments for a number of years. He's obviously had quite a significant background in M&A activity, which is obviously reasonably relevant for where we want to be right now. Steve Hampson is a director. He's also the CE at Powerhouse Ventures. Powerhouse provided the original seed capital for CropLogic back in 2010, alongside Peter Roble, who's the next director there. And Steve is basically just representing their interest in the company there. Peter Roble provided the other half of that seed capital at the outset and was involved with plant and food, so he had some good institutional knowledge of the company. Steve Wakefield, over on the right-hand side, is a very recently retired partner in Deloitte down here in Canterbury, so provides the financial muscle on the board. In the management team, myself, my background is largely in telco and ICT, other than the fact that I grew up on dairy farms through my earlier life. James Cooper-Jones is the CFO and company secretary and has been involved in multiple IPOs, particularly in resources in the Australian market. Dave Rankin, our CTO, actually vended in a telemetry business a couple of years ago. That telemetry business has given us obviously the expertise we need to roll out those probes and to develop them further, and also provided us with a viticulture client base here in New Zealand. And then finally, Matt Jenny, who's the Chief Operating Officer. Matt has a very strong engineering background and is obviously very relevant to seeing us push out those probes again into the US market. And finally, we obviously still have that support of Powerhouse there. At the 8 million raise, Powerhouse will represent some 15% of the shareholding. New Zealand Venture Investment Fund, which is a large government investment fund, those guys are with us as well and have supported us right the way through. They'll be sitting at about 7.38%. Callaghan Innovation, we've been recipients of Callaghan grants and loans in the past. Callaghan is essentially the government agency set up to support innovation. And Plant and Food Research, which obviously is where the company came from, they're now still, currently they're a 3% shareholder. We've obviously got a very strong relationship with those guys. We've got first right of refusal over any further technology which is relevant to our models, and also a preferential research agreement should we wish to delve back into scientific research. And then finally, the last page relates to the initial offering itself. So I can take questions on any of that, and apologies if I've just whipped over any of the key points there, but more than happy to answer questions.
Jamie, it's Rosie. That was excellent. Just before you get into the questions, I should have mentioned at the beginning that you guys put out a supplementary prospectus last night confirming that you've got the 5 million minimum raise, which is excellent news, and I should have mentioned that in the beginning.
Yeah, it is good. We've unfortunately the timing for that has come a little bit late. It's actually been sitting there for a couple of days now, but of course with the legal process that we go through and then lodging with ASX, it's taken a little while to get that news out. But yeah, hugely positive. That's obviously guaranteed our pathway through to this thing itself, and now it's just allowed us to target the 8. Can I invite any questions?
While everyone's thinking, Jamie, you've explained extremely well why you've gone down the acquisition path, but I must say I've always wondered why, or maybe you do, whether you don't concurrently distribute your technology just to individual agronomists as you go along.
No, look, I think that slide 11 really showed you the amount of value that we're adding into that chain there. And for us, really, the initial stages of this business are such that we want to make sure that we're capturing all that value. We also want to make sure that we are able to, completely control that quality. And, when we're talking about an acquisition of the magnitude that we have so far, that's, in fact, I didn't actually speak about the metrics of that acquisition, I'm afraid. Essentially, that business is turning over about 1.6 mil US, and we've done a deal which is for 1.8 million, and that's an 800k payment upfront, followed by $1 million over the next 3 years based upon warranted performance levels and whatnot. So essentially what we've been able to do is to pick up 30% of that Washington potato market for the sum of 800k US upfront. And I think that from our perspective, that represents a far less risky proposition to getting this product to market than even licensing or franchising or any other sort of indirect models that we could have employed to get there too.
Yeah, that makes good sense. Thank you.
When it comes to our expansion into other areas, I mean, one of our target markets is China into the longer term. We're not expecting to be revenue generating out of China in the next 2 years, but I can tell you right now that we're not going to be looking at 100% acquisition transactions as we have done in the US and that Chinese market. So that's going to necessitate a bit of a change of tack there. But in the meantime, because of the referenceability of that US market, it means that it's one for us to be able to really, really develop and capitalize on right now.
Mm-hmm.
Jamie, congratulations on the presentation and achieving the minimum for the IPO. One question I have for you though is it's not. I don't think it's in the supplementary, but it's in the initial prospectus, page 72, and that a conscious decision was made to classify redeemable preference shares as equity as opposed to liability, which goes against the standard as per the investigative accountant's report. What's the rationale behind that?
The independent accountant's report, yeah. Well, those are convertible notes, obviously, at the time, and this is basically what was provided back to us by Deloitte in the first instance, and then RSM again afterwards. We know very well that we're raising on a convertible note. We know very, very well that we're raising for a specific purpose here as well. The terms of that conversion were always around IPO, which we believe was under our control, which is why they were treated in that manner.
Okay. And then looking at the numbers there, is it a case of that the position of the shareholder equities looks like on the surface, it looks worse than what was outlined? I mean, that could also be part of this rationale as well, but just aesthetically, it looks a bit on the light side as well.
Yeah, look, the convertible notes were. I mean, that was probably a mechanism which has caused a little bit of confusion there. Convertible notes are reasonably well accepted here in New Zealand as that sort of final step towards listing itself. Mm-hmm. So I think that there's probably a little bit of confusion around that. Essentially that last raise that we did on the convertible note was also at a 0% coupon as well. So it really just sort of shows that it wasn't necessarily ever intended to be a debt instrument at all. That's probably the best way to explain it, I guess.
Sure. Okay. You mentioned. So I mentioned. You mentioned the if you got to the 8 mil raise that you were going to cash flow positive. Now that was over what period? Sorry, projected going forward.
Well, we're projecting over a 22 to 24 month period.
22, 24 months. Okay, and again, just trying to think simplistically here. That's to be cash flow positive from operations.
Yes.
Yeah,
and that's not assuming any acquisition.
That's not assuming any acquisitions, but this is where it becomes quite difficult for us, really, and that we know very well that there's an acquisition strategy on the cards here. I think we've articulated that reasonably well, reasonably clearly through the prospectus as well. So providing these forecasts and things, and obviously we are quite constrained from providing forward-looking statements. It just makes it even the more difficult for us to really provide those statements, in light of what are going to be very lumpy revenue increases, I guess, as a result of acquisitions.
Yeah, and also the time taken to fully integrate it into the existing models and doing all the shaping of that accordingly. That makes perfect sense.
Yeah, well, that's right. I mean, the US one that we've done so far, I mean, this also highlights another issue for us as well, which is potential timing of these transactions. We were able to settle on this deal in the US literally just before their busiest season. So it really affected our ability to transform the processes or anything beforehand. In fact, we were really struggling to get hardware up there into the market. We ended up deploying, almost 100 devices up there. But honestly, we could have shifted 300 to 500 based on the demand that we were seeing back from the growers, not the agronomists, but the growers. But again, it just highlights that there are a number of factors here which I guess could potentially delay maybe our ability to drive those efficiencies in. But I need to also go back to that first statement I made about the acquisitions, and that we're not out there looking to purchase loss-leading businesses at all. So while we may not make the timing in terms of seasonality of those businesses, we're certainly not going to be burning off cash in the meantime, and there is definitely development work that we can be doing whilst that season is underway.
And you might have already mentioned it, but again, I might have missed it, but is there a pre-existing pipeline of potential acquisition targets?
There is. Obviously, we can't publish that anywhere, but I can tell you right now there's an opportunity up there in Idaho. Mm-hmm. The one that was referred to us by Lamb Weston themselves, and there's also one in Australia as well. The Australian one's a slightly bigger opportunity than the one that we settled on in the US. And we have, we've been in talks with these guys, but there's nothing concrete there yet, so we're not representing anything in the prospectus. Sure.
And the last one for me, the again, without names or anything like that, but the makeup of the new investors on your registry, is it a combination of institutional and mum and dad clients, or even other investors from a government point of view in New Zealand or elsewhere, or what's the makeup?
It's actually a combination of all those things. We've obviously we need some spread as well, so we're going out to the retail base. Mm-hmm. We've got some pretty good institutional interest as well. I think the current book is sitting about 7.5 or something at the moment. So and the majority of that is actually built up with instos. And then we've also had some very strong interest. Well, it's not even interest; it's bids out of New Zealand from government funds as well.
Sure. Well,
so it's really come across the board, which is quite good. I think it's going to result in a reasonably tight register at the other end of it.
Excellent. No, that's fantastic news. Again, thank you for your presentation, and again, congratulations on the minimum raise so far.
Oh, thanks very much.